It is early March 2023. Jerome Powell spoke to Congress this week and indicated that inflation might be a bigger challenge than most people are expecting. So what does that mean for us as retired investors? Okay, today I'm obviously working from home in my very comfortable pullover because it's cold outside, but that's not the point of this video. In his testimony to Congress this week, Powell mentioned that there will need to be some financial pain before inflation is finally under control. The Fed's goal is to get inflation down to 2%. Nobody expects them to be able to do that by the end of this year. It looks like from the Fed's estimates that it's going to take longer than they originally thought. That's not truly surprising because, frankly, they were a little bit behind the curve on inflation. If you remember early on, they used the word transitory, which meant that inflation was going to be a short-term phenomenon that corrected itself. Then it became clear that it was not going to be a short-term phenomenon and that they were going to have to be more aggressive with interest rate policy to try to get inflation under control. I don't envy the Federal Reserve here. In a sense, they're flying blind a little bit. So when they raise interest rates, the impact on the economy is delayed from 3 to 6 months. So they really can't tell, even at this point, how much impact the aggressive rate increases they've been going on since last year have had. And so as they try to navigate this path forward, it's really a balancing act that I think is going to be very difficult for them. You would have expected to see employment slowing and a lot more layoffs than we've seen. And so that's the environment that they're in. What they're doing, these higher interest rates, isn't having the expected impact right away. And that's what they're analyzing. And I think that's also why it's so difficult, not only for them, but the markets to understand what might be happening next. So here we are in March 2023, and where we find ourselves is inflation is still elevated. It's been trending down since late last year, but that trend downward has slowed. And that's the thing I think that has the Fed concerned. One of the things that the Fed has been doing is raising interest rates at a relatively aggressive pace, although the last interest rate increase was a 0.25 percentage point. From what the bond market is telling us, they think that after Powell's comments this week, it's very likely that the next interest rate increase will be 0.5 percentage point. That remains to be seen. The silver lining in this increasing interest rate environment is that I think we can expect the bond side of our balanced portfolios to provide more return than they have in the last decade. So we're finally seeing some interesting yields. So that's why I think that, we can expect the bond side of the portfolio to do a bit more of the, not quite heavy lifting, but some of the lifting. In the recent past, bonds have provided more of a insulation from volatility than they have real returns in the portfolio. And I think we're going to see a change there. One thing that is still true from where we've been over the last year is there are so many different opinions on where the economy is headed, where interest rates are headed, and that's what makes a market. But I can't remember a time where those opinions have been as far apart as they are right now. What I take from that is, as investors, expect more volatility. We get new data, economic data every week, and we get new inflation data every month, and 1 month won't make a trend. But what the market is trying to do is determine those trends. And I think because the data sometimes is conflicting, for example, new jobs this week came out and beat estimates. So we're still in a very strong employment market. In fact, there are more jobs available than there are people looking for jobs. And so that conflicts with the fact that normally when you see Federal Reserve increasing interest rates like they have, you would see that unemployment would increase. And that just hasn't been happening. In fact, we're at historic lows from unemployment. So trying to apply textbook knowledge to the current economic environment really hasn't been working very well. And that's why I think the volatility will continue in the markets because of this changing data month to month, week to week, that might indicate different trends. I think you have to look over 3 to 6 months to really even have an idea of what's happening. To sum up, none of what's happening has really changed how we're managing the portfolios on a global basis. If you've had a balanced portfolio, we still want you in a balanced portfolio. We're always managing for the long-term goals, not what's happening in the short-term environment. Nothing we're seeing will change that philosophy. So that's the latest on the economic landscape.